Let's look at one more question. A, B, and C were in partnership sharing profits and losses in the ratio of 3:2:1. The partnership firm was dissolved on 30th of November 2013 when the position was as follows. So we have the balance sheet here, liability side, sundry creditors, 3,15,000, capital accounts A, B, and C, 2,10,000, 1,05,000, and 20,000 respectively. On the asset side, we have cash in hand, stock and trade, sundry debtors, worth rupees 50,000, 1,60,000, and 4,40,000 respectively. Additional information: the partners desired that the net realization should be distributed according to the rules at the end of each month. The realization and expenses were as under. So as on 31st of December 2013, expenses were 10,000 and assets realized 1,25,000. And then 31st of January, 9,000 and 1,88,600, and so on and so forth. Okay, so different dates have been given when the expenses you're going to pay and when you're going to get money on the realization of your stock and debtors. And the stock was disposed of and debtors were all realized. Set out cash and capital accounts showing monthly distribution of cash realized applying maximum loss basis. So here it's clearly given to us that we have to follow maximum loss basis. And again, just a quick reminder, if we tell you Garner and Murray method, then also you have to follow the same method, which is applying the maximum loss basis. Okay, now in this question, we have expenses and we have debtors. Okay, we have clearly been given what are the expenses, what are the debtors. So before I move forward to the preparation of the statement of distribution of cash, like we did in the previous sum, I would prefer to just show first a statement showing realization and distribution. Okay, I just want to show what is the amount we're getting on that date and how we're going to realize the values. Okay, so for example, as on 31st of December, we have 1,25,000. We're using some amount to pay expenses and remaining amount, how we're going to use that up. Okay, so we just want to give ourselves a clear picture of how we're using the amounts on realization. So let us start first with a statement showing realization and distribution of cash. Okay, statement showing realization and distribution of cash. Now, if you look at the question clearly, you'll see that we have expenses, right? We have expenses, we have creditors. In the balance sheet, we have the creditors on the liability side, and then in the additional information that we saw, we have expenses. So we have to pay for all of those expenses as well. And additionally, they've given also the amount on realization also. And besides that, the liabilities also include partners' capital, which also has to be paid off. Now, if you look in the balance sheet, you have on the asset side, you have stock and trade, sundry debtors, and cash in hand. Now, if you ever have a question wherein you have cash in hand, you know that we do not realize that money, right? Cash in hand is not going to be realized. Rather, it's going to be used to pay off your any existing, expenditures and so on and so forth. Okay, so here also when you're writing the statement showing realization and distribution of cash, the first thing that you should be writing is the cash in hand. So in the particulars column, you'll be writing the date of your balance sheet, which is 30th of November 2013. So against this date, we're going to write the reason why we have this date here. It is because it is an amount of cash in hand. Okay, this is the date we're getting from the balance sheet. The partnership firm was dissolved and so on and so forth when the position was as follows. Okay, so the total amount realized as on this date is rupees 50,000. And now you know that in case you have any money, the first thing you should do is pay off outside liabilities. So here your only outside liability is your sundry creditors worth rupees 3,15,000. So firstly, we'll pay our sundry creditors rupees 50,000. So nothing is paid out of realization to expenses and nothing to your partners as well. Okay, so next, let's move on to the next realization. See the second table that you have, the second slide, the realization and expenses were as under. So as on 30th of December 2013, you have certain expenses and you also have certain inflow of cash, realization of your stock and debtors. So let's write the date as on 31st of December 2013. Nothing in the brackets. Why? Because it's the amount we're getting from the table. So it's a given that we have to understand what that amount is. Okay, so as on 31st of December 2013, we have total amount realization worth rupees 1,20,000 1,25,000. Out of this 1,25,000, we have to pay expenses worth rupees 10,000 on the same date. Okay, rupees 10,000 worth of your expenses which are given in the table itself. Okay, so now out of 1,25,000, if you've paid 10,000, it means you have a balance of 1,15,000. Now you still have to pay creditors. Your creditors are still due. You've only paid 50,000, but your total creditors are rupees 3,15,000. So let's use this 1,15,000 to pay off our creditors. So now 1,15,000, that balance that you're having on your first realization has been paid off to creditors. So no balance is available to pay to your partner's capital. Okay, so sundry creditors are 3,15,000, correct? Out of that, you've now paid 1,15,000 and you've also paid rupees 50,000. So there is a balance still remaining 1,50,000 for your sundry creditors. Okay, we just keep that in mind and we'll move on to the second date. So as on the next date, 31st of January 2014. As on 31st of January 2014, you have inflow of cash 1,88,600. 1,88,600. And expenses as on that date are rupees 9,000. Okay, so out of this, let's see what is the balance you're having. Remember, creditors, we still owe them 1,50,000. So do we have that much money or not? So 1,88,600 minus 9,000. We are having total rupees 1,79,600. That means we can cover the full creditors' expenses of 1,50,000, but still enough money to spare. Okay, so out of 1,79,600, if we are using 1,50,000 to pay off our creditors, so the balance that you're having, rupees 29,600, is what we are going to give to our partners. Okay, 29,600 is going to go to our partner's account for paying the liabilities of your partners. Okay, so I hope this is clear. Then we're moving to the next date, which is 31st of March 2014. 31st of March 2014. As on that date, you're having inflow of cash worth rupees 1,04,650. And expenses on that date are rupees 7,000. Now creditors have been fully paid, no more money to be given to creditors. So whatever is the balance after paying your expenses will be used for paying off your capital account of your partners, which is 97,650. And then on the next date, we're following the same order basically, which is checking how much money is left in order to pay your partners. So as on 31st of August 2014, you have inflow rupees 1,14,750 and expenses amounting to rupees 6,000. No more money to be given to creditors. So the balance 1,14,750 minus 6,000, which is rupees 1,08,750. That is transferred to partners' capital. Okay, so we have one more amount as on 30th of November. So on that date, as on 30th of November 2014, we have stock and debtors realizing rupees 52,000. So cash inflow is 52,000 and we're paying expenses amounting to rupees 4,000. Okay, no more money for creditors. And the balance 52 minus 4,000, rupees 48,000 is going to be used for realizing the capital accounts of your partners. Okay, so all of the dates we've taken into consideration. We've started with the opening balance, of cash, right? We started with the opening balance of cash as on 30th of November 2013, and then we moved on depending upon the dates of realization. And we took into consideration the inflow and the outflow of cash, and whatever is balance we're using to pay off your partner's capital. So let's see, let's total these amounts. Total realization you are getting on the sale of stock and debtors and also on cash is 6,35,000 rupees. expenses are amounting to rupees 36,000 and creditors are amounting to rupees 3,15,000 and partners capital total is rupees 2,84,000. Okay, so this is our statement showing how we are distributing the cash when we are getting money on realization. Okay, when we are selling off our stock and debtors, the money that we're getting from that, how we're going to pay off our expenses and also our creditors. Now, the next step is showing distribution of cash on capital accounts. Now, okay. So the next one, let's prepare a statement showing distribution of cash on capital accounts. This is practically the same as we just did in the previous session, in the previous sum where we showed just statement showing distribution of cash. Okay, so remember this is maximum loss method. So here we are only going to show the total column and distribution of cash amongst the capital accounts of your three partners A, B and C. I am no longer going to be showing the distribution of the amount to the outside liabilities, that is your creditors and your realization expenses. Why? Because we already showed it in the previous table. So here we're just going to show how that remaining balance that you're having, right? This balance right here. Okay, so we're just going to be showing this particular column, how this balance 29,600 and then this balance also and this balance and this balance, how these four balances are going to be distributed amongst our partners. Okay, so these accounts, these amounts here, expenses and creditors, we are no longer going to be taken into consideration. Okay, so this statement, now let's start with this statement showing distribution of cash on capital accounts. So under the particulars column, firstly, it'll be distribution of the first amount that we are having, distribution of rupees 29,600. Okay, remember this is the amount that we're getting here, rupees 29,600 after we've paid off the various amounts due upon your different expenses. Okay, so 29,600, this is the first phase. So in order to do that, firstly, remember we take into consideration balance due. So how much do we owe the partners? So in order to calculate the balance due, we have to take their capital accounts. So the capital accounts of your different partners, partner A, capital account is amounting to 2,10,000, partner B rupees 1,05,000 and partner C capital account is rupees 20,000. So the total of these three amounts to rupees 3,35,000. This is how much we have to pay to our partners. So again, remember we put less, okay, possible loss, assuming remaining assets to be worthless. Okay, assuming remaining assets to be worthless. So this possible loss that we're getting, it should be distributed in the ratio of your partner's profit sharing ratio. Okay, so 3:2:1. This is given in the question clearly. Okay, so 3,35,000 minus 29,600, we're getting a balance of rupees 3,05,400. Okay, 3,05,400. Now 3,05,400 in the ratio 3:2:1. So for A, the share of loss is 1,52,700. For B, the share of loss is 1,01,800 and C's share of loss is 50,900. Now we have to calculate and see if they have surplus or deficiency of these accounts. So balance due minus the possible loss. So for A, it is positive figure 57,300. For B also it is positive 3,200. In case of C, 20,000 minus 5,900 is negative 30,900. Okay, so remember this is deficiency of partner C. he has a negative figure, right? So partner C has a deficiency. And in case of insolvent partners, remember Garner and Murray method, in case of insolvent partners, the partners who are solvent will make good their losses. So here, partner C has a loss of rupees 30,900. This will be made good by partners A and B in their capital sharing ratio, not profit sharing ratio, in their capital ratio. So next, let's write down deficiency of C's capital written off against those of A and B in the capital, in the ratio of their capitals, or in their capital ratio. So capital ratio of A and B, 2,10,000 is to 1,05,000. It should be 2:1 simplified. Okay, so capital ratio of A and B is 2:1. So 30,900 should be distributed amongst partners A and B in the ratio 2:1. So 30,900 is to be brought in by partner A in the ratio 2:1. Therefore, it amounts to rupees 20,600. And B has to bring in an amount of rupees 10,300. Okay, since they're bringing in, it's negative for them. And since they're paying to make good the loss of C, therefore it is a positive for partner C. Okay, hope it's okay so far. Now let's see how their figures are arriving at. So for A, 57,300 minus 3,600 amounts to a positive figure of 36,700. And for B, it is 3,200 minus 10,300. There is a negative figure of 7,100. And for C, it becomes nil. Okay, so here now we'll notice now the next partner who has a deficiency is partner B. Okay, partner C's deficiency has been clearly written off. Partner C's deficiency has been written off. Now we have another partner who has a deficiency, which is partner B. So partner B's deficiency has to be made good by the partner who is solvent, and the only solvent partner under this situation is partner A. So next, again, we'll be writing down deficiency of B's capital account written off against A's capital. Now under this situation, because there's only one partner left, okay, only partner A has positive balance. Only partner A has positive balance. Therefore, we don't have to calculate the capital ratio anymore. There's nobody to share this loss with. Only partner A, who is the only solvent partner, has to share the full loss. So therefore, he has to bring an amount of rupees 7,100 to make good the deficiency of partner B. Okay, no amount for partner C. Remember, he already has a nil balance. So now let's see. 36,700 minus 7,100 amounts to rupees 29,600. And in case of partner B and C, nil amount. So if you look at the distribution first, we are supposed to be distributing 29,600, correct? We're supposed to be distributing 29,600. In order to be able to distribute that, we had to figure out which partner is supposed to receive how much. So the full amount is going to be received by partner A. Okay, so the first realization of 29,600, the full amount is going to be received by partner A because the other partners have deficiencies in their accounts. So this will be manner in which rupees 29,600 is to be distributed. Okay, the partner who is going to be receiving the first realization amount of 29,600 is partner A. Right, so we've distributed the first amount. Now let's move forward to the next phase, next distribution. Distribution of your next amount. Check the second amount available for distribution to your partners. It is rupees 97,650. We're getting this from the first table. Okay, 97,650. So in order to distribute, first we need to figure out what is the balance that is remaining. So balance due after making payment as above. After making payment as above. That is after making your first payment, your previous payment. So you had 3,35,000 minus 29,600. This area right here, 3,35,000 which is the original total. After you've deducted 29,600, now we're getting a total of 3,05,400. So that is going to be your opening balance under this situation. Okay, so balance due after making payment is rupees 3,05,400. And the 29,600 that you had from the previous situation, that amount that should be distributed, only partner A was the recipient of that amount. Okay, so only partner A's capital account will be reducing to that extent. So 2,10,000, which is the original opening balance of your partner. Okay, so let's just look at this table to get the figures correct. So for partner A, 2,10,000, and he is already going to be receiving this amount of 29,600, right? So how much is it? 2,10,000 minus 29,600 will be the balance due in case of your partner A. So it should amount to rupees 1,80,400. Now, in case of partner B and C, in case of these two partners, they had balances of 1,05,000 and 20,000, right? And since there were no payments made to your partners, okay, yeah, there was no amount distributed to your partners, so therefore their balances will remain the same. So balance due for partner B and C, it amounts to rupees 1,05,000 and rupees 20,000 respectively. Fine. So now let us distribute the amount. And what is the balance due? Let's see. Less possible loss, assuming remaining assets prove to be worthless. The same statement once again. So possible loss is 3,05,400 minus rupees 97,650. Possible loss is rupees 2,07,750, which should be distributed in your profit sharing ratio 3:2:1 amongst the three partners. So 2,07,750 share of partner A is rupees 1,03,875. Share of partner B is 69,250, and share of partner C is rupees 34,625. Now let's see what is the balance and if there is any deficiency or not among your partners. Okay, so 3,05,400 minus 2,07,750. It's a given that will be the amount of your realization, 97,650. Okay, so partner A, 1,80,000 minus 400, positive figure of 76,525. In case of partner B, 1,05,000 minus 69,250, we're getting a positive figure of 35,750. In case of partner C, it is 20,000 minus 34,625. I'm getting a negative figure of 14,625. Okay, so there is a deficiency of partner. So you very well know that in case there is a deficiency, it means the partner is insolvent, and the loss or the deficiency of insolvent partners will be made good by the solvent partners. So the next thing will be the deficiency of your insolvent partner written off against the amounts of your solvent partners. Okay, so next is deficiency of C's capital will be written off again those of A and B in their capital ratio. Now capital ratio remains the same. That is the opening balance. Okay, from the balance sheet that you're having, we're going to use that same capital. So the capital ratio will remain the same as 2:1. 2,10,000 and 1,05,000, 2:1 ratio. So 14,625 will be brought in by partners A and B in the ratio 2:1. Therefore, partner A is bringing in 9,750. Partner B is bringing in 4,875. Okay, these are the amounts to be brought in by your partners in order to make good the loss or deficiency of your partner C, who is the insolvent partner. So let's see what are the balances under this situation. So partner A, 76,525 minus 9,750. It should amount to 66,775. In case of partner B, it is 35,750 minus 4,875. It should amount to 30,875. In case of partner C, nil amount. Okay, so right. Therefore, here you'll notice that there are no longer any more insolvent partners. Both of the partners are solvent. So what is the total? Let's just calculate the total. 66,775 plus 30,875. It should amount to 97,650, which is the exact amount of your realization available. Okay, so basically this is the manner in which this amount is going to be distributed. So let's write it against the total manner in which your second realization, right, in which rupees 97,650 is to be distributed. Okay, the manner in which this is distributed is partner A is getting so much, partner B is getting so much, and partner C is not getting any amount at all. Okay, so that was the second realization. Then on 31st of August again, 2014, we're having an amount of 1,08,750. So next case is your third situation. So for the third realization, again, we're following the same steps. There's nothing different here. We just have to figure out if a partner has deficiency or not. And if they have a deficiency, we just have to make good the loss. Otherwise, more or less, we're following the same steps. Next will be distribution of your next amount on realization, which is rupees 1,08,750. And just as usual, balance first, balance due after making payment as above. Okay, after making payment as above, or you can write after making the previous realization, after making payment of previous realization. You can write that also, it's not a problem, but we're preparing it in a table format, you know, one follows the other. So after the above payment is also quite suitable here. Okay, so the balance you're having here under the situation, let's see. Yeah. So originally it was 3,05,400, but you've paid 97,650, and now you're left with 2,07,750. So balance due in total is 2,07,750. And in case of partner A, in case of partner A, we had a balance due of rupees 1,80,400, right? We had a balance due 1,80,400, but he is receiving payment of 66,775. Similarly, in case of B also, 1,05,000 was due, but he received 30,875. And in case of partner C, the due was 20,000, but he's not receiving any money at all, right? So his balance remains constant. Therefore, let's fill up this column here. Okay, so for partner A, it is the amount is rupees 1,80,400 minus the amount received 66,775. So it should be rupees 1,13,625. In case of partner B, his balance due was 1,05,000 and he's received 30,875. So he should be having a balance of 74,125, and partner C has not yet been paid, so full balance of rupees 20,000. So now let's get started with the distribution of the amount. So less possible loss, again the same statement, possible loss, assuming that the remaining assets prove to be worthless, and we're sharing it in the ratio 3:2:1. So if you're receiving an amount of 1,08,750 and your balance due is so much, the possible loss is rupees 99,000, which is 2,07,750 minus the amount you're receiving, 1,08,750. Balance is 99,000, which is to be distributed amongst your partners in the profit sharing ratio 3:2:1. Therefore, partner A has a possible loss of 49,500. Partner B has a possible loss of 33,000. Partner C has a possible loss of rupees 16,500. Now let's calculate and see if there's any deficiency. So in case of partner A, 1,13,000 minus 625, we have a positive figure of 64,125. In case of partner B, the amount is rupees 74,125 minus 33,000. We're getting a positive figure, 41,125. And for partner C, 20,000 minus 16,500, positive figure of rupees 3,500. So none of the partners have a deficiency. Let's calculate this total and see. 64,125 plus 41,125 plus 3,500. We're getting a total of rupees 1,08,750, which is the amount that we're supposed to actually distribute. Okay, so this is how we're distributing this amount. So we'll write this as manner in which rupees 1,08,750 is to be distributed. Okay, the manner in which your amount that is there for realization, how we're going to distribute it amongst your partners. Okay, so that is also done. Now we still have one more realization, that is, so your fourth and final realization, okay, which is distribution of your final amount. If you look at your first table, you'll figure out distribution of rupees 48,000. And as usual, firstly, balance due, right? We have to open up with your opening balance, just like in case of ledgers. So balance due after making payment as above. After making payment as above. So check what are the balances that are due for your partners. Here we can easily identify what are the balances due. Why? Because everybody has been paid. So since everybody has been paid, everybody is going to have a different balance, which is this amount. Okay, so that is the balance that is due for all of your partners. Total 99,000. So for A, balance due is 49,500. B has a balance due of 33,000 and C has a balance due of 16,500. Now let's make them the payment as per the balance amount that we're having, the last realization amount of 48,000. So this would be less that statement, possible loss assuming the remaining assets proved to be worthless. So this will be again in the ratio of the 3:2:1, which is their profit sharing ratio. Fine. Okay. So 99,000 minus 48,000 will give us a possible loss of 51,000. So distribute 51,000 amongst your partners in the ratio 3:2:1. For partner A, he has a possible loss of 25,500. Partner B has a possible loss of 17,000. Partner C has a possible loss of 8,500. So now let's subtract the balance and the possible loss and see if we have any deficiency. So for partner A, 49,500 minus 25,500, we have a positive figure, 24,000. Partner B is 33,000 balance minus possible loss 17,000. I have a positive figure of rupees 16,000. And partner C is 16,500 minus 8,500, positive figure of 8,000. No partners have deficiency. Get the total, and this 99,000 minus 51,000 should be equal to 48,000. If it's equal, then that means your calculation is correct. So this will be manner. Now remember, there's no deficiency, right? So manner in which the amount of rupees 48,000 is to be distributed. Okay, how each of your partners are going to be receiving the amounts on realization. So the possible loss of your partners after all of the realizations have been paid, after they've been paid for the realization, the final amount that is due for your partners are this amount: 25,500 for A, 17,000 for B, and 8,500 for C. These are the amounts that are still due to them after all of the payments have been made. Fine. So this is calculation of the losses for your partners, taking into consideration the Garner-Murray method or maximum loss method.